Hi guys, keep watching KS tutorials. They are the best.
Guys, keep watching KS tutorials. They are the best. Hello guys, welcome back to KS tutorials. On today's episode, we'll be talking about the presentation of the financial statement. That is IAS 1. IAS 1. IAS 1. Presentation of the financial statement. So when we talk about presentation of the financial statement according to IAS 1, it means that, or they mean that the IAS 1 set out the procedure or ways in which financial statements are supposed to be presented as an accountant. So if you are an accountant, the IAS 1 is giving you ways or procedure in which you are going to present the financial statement. Do you get it? Yes. So the IAS 1, which provides requirements, procedures, format in which the financial statement is presented. Do you get it? Yes. So why do we need IAS 1? Why do we need IAS 1? The purpose. So one, the IAS 1, it ensures that financial statement provides reliable information. Reliable information. We have relevant information. We have useful information, and then understandable information. So the IAS 1 helps the financial statement to be reliable, to be relevant, to be useful for the users, and then to be understandable, very simple to understand. You get it? So it gives you the layout as to how the financial statement is going to be prepared. And then after it has given you the layout or the requirements needed to prepare the financial statement, IAS 1 also makes sure that the financial information that is being provided is reliable. The financial information that is being provided is relevant, it is useful, and then it is understandable. Very clear, right? Yes. So that's the purpose for the IAS 1. That's the purpose for the IAS 1. Okay. So now let's move on to the components. Let's move on to the components of the financial statement. So when we talk about the financial statement, what are the components of this financial statement that we are talking about? If you talk about the financial statement, what does it mean? What entails the financial statement? What makes up the financial statement? That's what we are going to talk about. So the financial statement is made up of the statement of financial position. So when we talk about the statement of financial position, it used to be balance sheet, but now this is the name that, according to IAS 1, this is the name that is used, statement of financial position. So it gives the users of financial information the financial position, whether the company is performing well or not. Do you get it? Yes. So the balance sheet, we have items that or elements that entails the statement of financial position. We'll come to that. So the first component of the financial statement is a statement of the financial position. We have So that's the second one, statement of profit and loss and other comprehensive income. So this is where the revenue and then the expenses are captured. The statement of profit and loss and other comprehensive income. The revenue and then the expenses, this is where they are captured. Okay. Now let's move on to the next one. We have statement of changes in equity. So when we talk about equity, we mean shares, we mean retained earnings, those things, they are all part of the equity. So let's talk about the statement of changes in equity. Whenever there are changes in equity, let's say there are additional shares, let's say the company made a profit or loss, let's say they pay dividend, they are all changes that happens in equity. So when those changes happen, we need to capture them in the statement of changes in equity. Do we get it? Okay. Then the next one we will talk about is statement of cash flow, or in other words, cash flow statement. So when we talk about the cash flow statement, this one deals with cash items, anything cash. So when it is accruals, you do not capture in the cash flow statement of cash flow. This one we'll talk about this more when we get to IAS 7. IAS 7 set out the rules or the requirements you need before you can prepare an account or the cash flow account. So the IAS 7 provides more information about the cash flow account. When we get to IAS 7, we'll talk more about the cash flow statement. Do we get it? But for now, we just wanted to know that it is part of the financial statement. Part of the financial statement. Do you get it? Okay. Then the next one is the last one is the notes. Notes to the account. So all these accounts, the statement of financial position, the statement of profit and loss, the changes in equity, the cash flow statement, any information that, let's say, breakdown or anything, we are supposed to capture in the notes to the account. So the notes to the account will set out the standard you use in preparing your financial statement. Any additional information, any information that you want the user of the information to know, you are supposed to capture it here. Do we get it? You are supposed to capture in the notes of the account. Very clear, right? Okay. All right. So the next one we are going to talk about is the elements. So all these components of the financial statements, they have elements that you are going to see in them. So let's say when you pick them, statement of financial position, there are some key elements you are going to see. Those elements must be seen on the face of the financial statement or on the face of the statement of financial position when you are preparing it. Those elements must be seen on the face of the profit and loss when you are preparing it. Those elements must be seen on the face of the changes in equity, must be seen in the cash flow, must be seen here. Do you really get it? Okay, so let's pick the first one. That is the first one is the statement of financial position. So when we talk about the component or the element of this one, we have assets. So we know we've already spoken about assets. We said assets are the economic resources which the company owns and control. Yes. So the assets are parts. The assets, you will not see the assets in the statement of profit and loss account, but you see assets in the statement of financial position. You will see liabilities in the statement of um, financial position. That's where you are going to see liabilities, assets, and then you see equity. So these three, you see them in the statement of financial position, SFP. Do we get it? You see them in the statement of financial position, assets, liabilities, and equity. You see them in the statement of financial position. And then when we come to the statement of profit and loss and other comprehensive income, this one we are going to see more of income items. So income or revenue. We have, and then losses. Those are the things you are going to see here, or expenses. Do we get it? So those are the things you are going to see here in the statement of profit and loss and other comprehensive income. So you are going to see more of income, revenues, losses, and expenses. Those are the things you are going to see on the face of the profit and loss account. Do we get that one too? Okay, so when we move to the statement of changes in equity, yes, changes in equity. So you are going to see something like stated capital or equity, stated capital. You are going to see something like retained earnings, retained earnings. You're going to see something like revaluation surplus, revaluation surplus, and then yes. So these three, you are going to see them. You have capital surplus, and other things. But yes, you're going to see all these three constant in the changes of equity. And then when it comes to cash flow, we have operating activities. We have financing activities. And then we have the last one, investing activities. So when we get to IAS 7, we'll talk more about the operating activities, the financing activities, and then the investing activities. So stick with us. We'll give you very good explanation of what they are and then how you can treat them. Very simple way of solving IAS 7. Do we get it? But when we get there, we'll talk about that one. But for now, we are on IAS 1. We just want to give you the requirement, what you need before you prepare a financial statement. Do you get it? Okay, so when we talk about the notes, so the notes talks about the accounting policies, the policies you are going to use. We talk about them and accounting policies and other explanations. So let's say how you manage to get your assets. Maybe you have a breakdown how you got your PPE. You are going to capture in the notes the policy you are using, whether how you value inventory, you are going to use lower of cost or whatever. That one too. You are supposed to, like every policy you are going to use, you state it clear, categorically in it in the notes to the account. Do you get it? Yes. So that is the notes to the account. Very simple, very clear, right? All right. So now we are done with this. Let's get the layout of this one, how it you see it. So when we take the statement of financial position, which used to be the balance sheet, how will it be presented? So we have, let's say we are in Ghana, so we have, let's say, the Ghana cedi sign here. I make it two. We have it here like this. So this is the format, how it looks like. So first we have our non-current assets. So when we talk about non-current assets, we mean the assets that will not be used, or let's say that cannot be traded in the near future, let's say within 12 months after reporting. Do we get it? We cannot turn that asset into cash within the next 12 months. Do we get it? Yes, because reporting is in 12 months. In any case, when you are not able to report in 12 months, you have to state the reason why you are not reporting in 12 months. Do we get it? Okay, so we have the non-current assets. Non-current assets. And then non-current assets, we have PPE, property, plant, and equipment. Property, plant, and equipment. So this PPE captures items like building, we have motor vehicle, we have land, we have so all the fixed assets. Fixed assets, when we talk about fixed assets, we've spoken about fixed assets already. So those are the non-current assets or the PPE. Those are the PPE. When we talk about the fixed asset, they are the PPEs. Okay, and then we have intangible assets. So let's say we capture it here. And we have intangible assets. When we talk about intangible assets, they are the goodwill. We have those ones, goodwill, maybe customer base, those things. They are your intangible assets. Do we get it? Yes. So your intangible assets will also come here, will be captured here. And then the last one is investment property. So your investment property will be properties that you are investing, like as in you'll be hiring, maybe you have a land or an office space that someone will be hiring. So that one is your investment property. That one too, we have IAS that tackles that one too. Okay. And then we can sum all. And then we come to our current asset. Current assets are, if non-current assets will not be used in the next 12 months, then current assets are assets that will be used in the next 12 months after reporting. So let's say we reported maybe 31st December. So within from 31st January to December, assets that will be used are current assets. The ones that will not be used are non-current assets. So when we talk about the non-current assets, we have inventory. Other people will say stock. So inventory will be captured here. And then we have trade receivables. Trade receivables. So trade receivables are those who are owing the company. You supply goods to them. They are here to pay you. They are your trade receivables. They are owing the company. And those people will settle within the 12 months period. Your inventories are the stock you have in your office that you'll be selling within the 12 months. Not the ones you've sold, the ones you have remaining that you will be selling within the next 2 months, the next 12 months, sorry, the next 12 months before reporting, the next reporting, the ones you'll be selling before. And then your trade receivables, as I said, those who are owing you, but they will pay within the next 12 months. Okay, that one will be here. We have our prepayment. You have expenses that you paid in advance. You paid expenses in advance. It's an asset to you because let's say you have light and then you pay the light for maybe instead of paying for the particular year, you paid and then let's say 3 months advance. That 3 months advance becomes an asset to you, but you consume it in the first 3 months of a year. So it will not go to the other other reporting year. By the end of the reporting year, you would have consumed it. So we capture that one to as current asset because you use it before the time which is the reporting gets there. So we have that one too here. We have our cash and cash equivalent. So we say cash and cash equivalent because let's say we have physical cash and then we have cash at bank. We put the two together and then we have our cash and cash equivalent. So our cash and cash equivalent, that's cash and bank. We have that one too. So when we add the two, when we add inventory, trade receivable, prepayment, and then cash and cash equivalent, whatever we get, we bring it here. We'll bring it here to come and get our total assets. Do you see? Now we have our total assets. That is when we added our non-current assets and then our current assets. We had our total assets. Very clear, right? Okay. Now let's move on to the next one. That is, let me close this side. So now we've closed our assets. Now we move on to our equity and liabilities. Our equities and liability, equity and liabilities. So first we come with a stated or equity. Equity. So equity, we have stated capital. We have our stated capital here. It will be here like this. We have our next our retained earnings here. We have our, let's say, where are the changes in equity? Total capital, retained earnings. We have our revaluation, surplus. And to here, the two gives us our equity. Then we move on to our liabilities. That's non-current liabilities. So when we talk about the non-current liabilities, they are the owings. Owings, let's say you are owing, the company is owing people. So the owings that will exceed 12 months. It will exceed 12 months after reporting date. If you are going to report end of year 2025 December, owings that we know that by after 2025 December 2026, we are still not going to settle. Let's say we are going to settle in 2027 or 2028. Those owings come here. Do we get it? So loans, all borrowings, they all come here. If they are a lot, you put them here, you sum up and then bring it here. You have our current liability. Current liabilities. So the current liabilities, as you know, they are the owings that we are going to settle in the next 12 months. Okay, so that one, so let's say we have trade payables. Trade payables, which will be here. We have our accruals. Or yes, accruals, expenses that we are owing, we are here to pay. Maybe light bill, we are owing some amount of light bill that will be paid in the following year. That one too is supposed to be captured here. And other short-term liabilities. So now we'll add our equity items, our non-current items, and then our current items. Whatever we get will be our total equities and liability. Total equity and liability, which is supposed to be the same as this. The amount you get here is supposed to be the same as this. And then you can say your balance sheet has balanced, or you can say your statement of financial position has balanced, which means you did your double entry correct. But it doesn't mean whatever you did is correct, but it means you did your double entry correct. Do we get it? The balance sheet can balance, but maybe there are some errors, or maybe errors that you committed. You have errors that do not affect the balance sheet. You have errors that affect the balance sheet or the trial balance. Errors that affect the trial balance, and then errors that do not affect it. Yes. So the mere fact that it will balance doesn't mean every figure you quoted there is correct, or the totals you have quoted here is correct. Do we get it? Yes. It just means you did your double entry correct. Yes. So this is the format of the statement of financial position. If there's any question, if there's anything you want to ask, please do that in the comment section. Don't hesitate. We'll come back to answer you. Thank you. Now let's move on to the other one, which is the statement of profit or loss. Profit or loss and other comprehensive income, which is OCI. So if you see OCI, it is other comprehensive income. So profit or loss or other comprehensive income. All right. So with that one, let's make the same two currency signs. All right. So we have revenue here. We put it here. Can put it here. And then we less cost of sales. Cost of sales entails purchases, opening balance, closing inventory, opening inventory. We have purchases, we have carriage in was and others. Yes. So those things will come into the cost of sales. And then you do all the calculation in your notes. You bring the final answer here. Come and list it here. Do you get it? Whatever you get. No, we should learn to put the two here. Whatever you get here will become our gross profit. Our gross profit. So now we have our gross profit, this. And then we add other income. So other income that you made during the year, you add that one to this. Do you get it? And then we less whatever we get, we less our operating expenses. What are our operating expenses? We have distribution costs, distribution expense. That will be here. We have our administrative expense. That will be here. And then we have any other expense too. We add that one to here. Whatever we get, we'll bring it here in brackets. The our expenses will be less. And then we'll come and get our operating profit. So profit from operation down to be here. All right, and then we go ahead to add our, if you have finance cost, finance income, and then we less finance costs. So let's say if maybe we had finance income, let's say we gave money out, we loan somebody, and then there's interest that is coming into the business, we'll add it. If let's say we borrowed money and then we have to pay with interest, that interest will also come as well. The finance income is when we are getting money, and then the finance cost is when we are paying interest. So when we are getting interest, finance income, when we are paying interest, it's finance expense. So that one too will be here. So we less it. If it's a positive, we add. If it's a negative, we less. So it's a plus or minus. Yes. So when we do the two, whatever we get here becomes our profit before tax. Do you get it? Profit before tax. And then we less tax. When we less our tax, we are getting profit after tax. Profit after tax. Do we get it? And then when there's other comprehensive income, so other comprehensive income will be revaluation expense, revaluation income. Let's say we did a revaluation and then we had a gain. That gain will be other comprehensive income. Do we get it? So when there's OCI, other comprehensive income, we will add it. We'll add it, and then we come and get our profit for the year, or total comprehensive income. Total comprehensive income. So first, we have our revenue here. We less our cost of sales, which has the purchases, the opening balances, the carriage in was, carriage out was, everything is here. We add it here. We have our profit after tax. We have our gross profit here. So gross profit, and then we add our other income. When we add our other income and then we less our expenses, which are our operating expenses, which are the distribution expense and administrative expenses, we are going to get our profit from operation. The normal profit we get from our normal operation. Do we get it? And then if there's a finance income, that is, we gave money out as loan and then someone paid interest to us as a finance income. If there's a finance income, we will add it to our profit, operating profit. Or if there's a finance cost, we took a loan and we are paying interest. That one we will less it from our operating profit, and then we come and get our profit before tax. Profit before tax, because it is a profit we are yet to deduct what tax. Do you get it? It's a profit we are yet to deduct tax. So when we deduct, we less our tax from our profit before tax. We are getting profit after tax, or profit for the year. That's the normal profit from business operation, profit for the year. And then when there's revaluation, we don't bring it here as part of the other income. We bring it here after the profit after tax or profit for the year. Do we get it? When there's a revaluation, we bring it here, other comprehensive income, we add it, and then we come and get other total comprehensive income. That would be your total comprehensive income for the year when we add all other incomes. That's revaluation gain. We assume it's an income. So when we add it, we are getting our total comprehensive income. Do we get it? Very simple, right? Yes. Now let's move on to what we call the statement of changes in equity. Wow. Statement of changes in equity. So from here, we have our equity here. Any changes that will happen in the here, we do it here before we bring the final amount here in our balance sheet or in our statement of financial position. Do you get it? Yes. So we have our stated capital here. Capital here. We have our retained earnings here. We have our revaluation. Surplus here. And then we have our total here. So let's say we have our opening balance. We put it here, put it here, we put it here, and then we sum the three to get this. We have our total here. And then we have let's say profit for the year. Profit after tax. So normally we bring the profit after tax under the retained earnings. Do you get it? So profit. This profit that will make here profit after tax. You will bring the amount here. You come and add. So meaning here will be dash, and then you add the 3, you are getting this. Okay, let's say we paid our shareholders. You know, shareholders, they receive dividend. Yes. So when we pay them dividend, we are supposed to record it here. So dividend paid. That one to go under the retained earnings. So we will deduct. Do we get it? We will deduct from our retained earnings. So here will be clear, right? Okay. So it's negative. Now maybe we did a revaluation in the course of the business. So maybe we had building that we realized that the building, from the look of things, the building has gained value. So we called an expert to come and revalue or do feasibility checks and everything on the building, and then they realized that, oh yes, the building has increased in value. That increment in value is supposed to be captured in the changes of equity, and then here as other income. So revaluation. So the revaluation can be a gain or a loss. Whether it is a gain or it's a loss, you are supposed to bring it here. So if it's a loss, we put it in bracket, we subtract. If it's a gain, we add. Do we get it? Yes. Okay, so it's a plus or minus. Do we get it? If it's a gain, we add. If it's a loss, we less. Okay, then let's say the company issued additional shares so that they will get additional money for the business. So that additional shares be issued, we are supposed to capture it in the changes of equity because it has changed, it has increased the capital we have. So additional shares, that will be captured here. When we finish, we just add this. So here will be the total. And then this. Then we add a 3 to get this. So when you add here and then you add here, you are supposed to get this. So this amount is what you will see here as the total equity, the equity side. This amount will be the same thing here. These figures, this one will be for the stated capital here. The retained earnings will be here. And then the revaluation is what will be here. Do you get it? Yes. Okay. Now, so when we talk about the cash flow statement, because we are done with the statement of changes in equity, as I said, IAS 7 gives the layout, the format for the cash flow statement. So when we are doing the IAS 7, we will talk more about the cash flow statement. So, and then the notes, as we said, the workings as to how you got your cost of sales, as to how you got your total revenue, as to how you got your PPE, as to how you got your inventory, your trade receivables, everything will be captured. It's supposed to be captured in the notes, and then the underlying standards, the whichever principle you used in preparing the statement is also supposed to be captured. Do we get it? Okay. So thank you for watching KS tutorials. Thank you for listening to us. We are glad. Whichever issue you have, you can contact me. I also organize private classes. That is, if you want a private section with me, you can contact me. My number will be provided. You can contact me, and then we have a discussion as to how we can go about it. Wherever in accounting you have issues, we can solve it from there. Thank you for listening to KS Tutorials. Thank you for listening to me. My name is Mr. Sam, and I'm out.